Hi everybody. There were a few questions regarding accumulated depreciation and what it means to be a contra asset account. We were introduced to this topic in Chapter 3 as we are learning about adjusting entries. So, like you've learned, one of our adjusting entries that we make at year end is the adjusting entry to record depreciation expense. Basically, when we buy a long-lived asset to use in operations to help us generate revenue, when we purchase those assets, we record them as fixed assets. They are long-term assets, and we record them on our balance sheet at their cost, which is the price we paid for them. We never change that amount. It's part of the cost principle concept that states we list our assets at the price we paid for them. However, even though we keep the assets at the cost we purchased them at, if you were to buy a piece of equipment that had, let's say, a 5-year life and you use it every day in operations, well, that machinery is not going to be the same efficiently running piece of machinery on day 100 of year 5 as it is on day 1 of year 1. Over time, it's going to lose some of its use. To capture that loss of use, we record depreciation each year. So I want to start with a very simple example I set up. I'm going to show you the journal entries we make, the posting of the entries to the accumulated depreciation account, and then I will also show you the effect on the balance sheet. So let's start with the example. On January 1, 2016, ABC Company purchases a piece of equipment for $10,000. The useful life will be 5 years with no salvage value at the end of its life. What will be the adjusting entry at the end of the next 5 years? So at the end of every year, we're going to record depreciation expense. So far, we've only learned about the straight line method, and that tells us that we take the purchase price of the equipment, which is $10,000, less any salvage value. Well, in this example, there is no salvage value. So 10,000 minus 0 still leaves us with 10,000. And we divide that number by the number of years in its useful life. That would be 5. So each year, we are going to record depreciation expense for this piece of equipment in the amount of $2,000. Right down here, I've already included the December 31st, 2016 adjusting entry for the depreciation of this piece of equipment, where we debit depreciation expense $2,000 and we credit accumulated depreciation $2,000. If we were to post to our ledger accounts, here is our T account for accumulated depreciation. In year 1, we will have posted the first amount of $2,000, which would leave us with a balance in accumulated depreciation of $2,000. So after 1 year, after our adjusting entries and after we prepare our adjusted trial balance and we see our credits equal our debits, we go ahead and we prepare our balance sheet. So I'm going to scroll down, and I have here just a snapshot of our balance sheet. Remember, keep in mind that the first financial statement we prepare is the income statement. The second financial statement we prepare is the statement of retained earnings, and then the balance sheet will be third. This is just a piece of the balance sheet, and I have here only the asset section. I've listed cash, accounts receivable, and prepaid rent. Merely for illustration purposes, I made up these amounts right here, so don't try to tie them to anything. Down here is what we're going to be focused on. The equipment we purchased is listed under assets at $10,000. Again, that's the price we paid for it. Just below equipment, it says less accumulated depreciation for equipment, and it's listed as a credit of $2,000. So our accumulated depreciation accounts are what's called contra asset accounts. A contra account is an account that has the opposite normal balance as the other assets listed in its category. This is a contra asset account. So as you know, most assets have a normal debit balance, but since this is contra, it goes against that, and its normal balance is a credit balance. So our normal debit balance for equipment netted against our credit balance for accumulated depreciation yields a difference of an $8,000 debit balance. That result, the net amount, is what's referred to as the net book value. So your cost for the asset less accumulated depreciation yields you net book value. So after 1 year of depreciation, this is what the asset would look like on the books or on our balance sheet. Okay, so let's see what would happen in year 2. Same entry every year, right? Nothing's really going to change, same amount. We are depreciating by a straight line. Okay, so there we are, same entry, depreciation expense debited $2,000, accumulated depreciation $2,000 is credited. So let's go back and post that to the ledger. This is a accumulated account, so every year we are adding to the balance. Another $2,000 means our balance now in accumulated depreciation is $4,000. Okay, come down here, once we begin to prepare our financial statements and we get to the balance sheet again, let's assume some of these amounts have changed. Completely making them up. Okay, we still have our equipment listed at cost. That does not change. However, our accumulated depreciation balance, as you see right here, is going to change on the balance sheet. So now our cost of $10,000 less our accumulated depreciation, which is now 4, shows us our net book value is now 6. Let's go up and finish the remaining. We will continue that for 5 years. So let's do the next 3 years. Okay. And there you go. Okay, so there's our accounts. By year 5, we have captured all 5 years of depreciation. Let's put the dates. And 12/31/2020, there you go, for a total of $10,000. Technically, if we've held the asset that long, we fully depreciate it. At the end of 5 years, we've captured the full cost. And we will go down here again once it's time to prepare our balance sheet. Okay, we are going to, let's change the date. And our accumulated depreciation account is now $10,000, resulting in a 0 net book value. That is why we use the contra account. Since we don't change the cost of the asset on the books and it always remains at the price we paid for it based on the cost principle, we have to reflect the loss of usefulness that increases over time. And we do that with the accumulated depreciation contra account. I hope this helped you see a little bit how the accumulated depreciation account works, why we record the adjusting entry, and what it looks like over time on our balance sheet. Please do me a favor, let me know if this helped you at all. Include a quick note to me either in the forum or in email, and let me know if this cleared things up. I hope it helps.